Hey everyone, welcome back to the channel. Technical analysis is a universal language for global markets, but trading rules are the local laws. Today, while explaining candlesticks, moving averages, and trends, I'll consistently compare the rules of the A-share market with international markets like the US and Hong Kong. This will help you invest wisely, no matter the market. Let's start with candlesticks. This small candle records just 4 prices: the open, close, high, and low. Investors worldwide use it. However, its colors mean different things in different markets. In A shares and Hong Kong stocks, green represents a price increase, and red represents a decrease. But in the US stock market and most other markets, it's the opposite. Red means up, and green means down. Don't get this first impression wrong. When the closing price is much higher than the opening price, forming a long green bullish candle, it usually means very strong buying pressure that day. But this is where trading rules come into play. In A shares, due to the 10% daily price limit, the length of the real body you see is restricted. In contrast, in US or Hong Kong stocks without price limits, you might see candlesticks with extremely long bodies, where prices can swing 50% or even 100% in a single day. The market sentiment behind those moves is far more intense than in A shares. To smooth out candlestick volatility, we use moving averages. Think of the 5-day MA, the critical 60-day MA, or the 250-day annual line. Their calculation is the same globally, but how you use moving averages is influenced by trading systems. A key difference is T+0 versus T+1 settlement. In US and Hong Kong markets, T+0 trading is the norm. This means you can buy and sell the same stock on the same day. This allows short-term traders to execute very flexible strategies around moving averages. For example, they can buy when a stock pulls back to its 10-day moving average and sell later the same day if it rallies. In A shares, we have a T+1 system. Stocks you buy today can only be sold starting from the next trading day. This means that even if you enter at a perfect buy point like a moving average bounce, you cannot execute any sell order for preventing loss or profit taking that same day. Therefore, using moving average strategies in A shares requires more patience and a longer time horizon. You can't simply copy the ultra-short-term tactics used in T+0 markets. Finally, let's talk about the trend. It's a universal truth. The trend is your friend. The method of drawing trend lines is the same everywhere. Connect successively higher lows for an uptrend, or lower highs for a downtrend. However, the strength and stability of a trend are deeply affected by market rules. A shares price limit system can sometimes distort short-term trend expression. For instance, a stock might start rising due to good news and hit consecutive limit up boards, creating a very steep, parabolic trend that is impossible to enter midway. In markets without price limits, trends typically develop more continuously. You can almost always find entry and exit points along the way, allowing technical analysis tools to be applied more smoothly. Furthermore, when judging the scale of a trend, consider the investor composition. The A-share market has a higher proportion of retail investors, which can lead to trends being more volatile and driven by sentiment. In markets like the US, with a higher concentration of institutional investors, trends may be relatively more stable and rational. Alright, let's summarize the core ideas. First, candlesticks, moving averages, and trends are the universal grammar you must learn. Second, trading rules are the unique local accent. The T+1 system and price limits in A shares create a completely different trading rhythm and strategy compared to the T+0 and no price limit environment of US/Hong Kong markets. So, in your investment toolkit, you need both the globally applicable technical analysis tools and a deep understanding of the specific rules of your target market. Only then can you develop truly effective strategies. I'm Richard. If you found this helpful, please subscribe to the channel. See you in the next video.